When we talk about credit analysis, there is the borrower and there's the lender. The lender, I'm speaking sort of across the board, bank lender or a bond investor, all across the board. If it's commercial paper, it's commercial paper investor. It can be a debenture, corporate bond. It can be a bond investor. It can be a convertible bond investor. It can be a bank. As I said, we can short-term, long-term bank, big bank, small bank, of all means. We make the loan, there's the borrower, got to get paid back, and then of course we're going to look at the marketplace to assess the degree, what's the probability that we may not get paid back. What is that probability that we may not be paid back? One of the most important parts of credit analysis is ultimately, in all cases, we as investors or lenders, ultimately what we have to do is make a decision. Do we lend or do we not lend? Do we want to do business with this client or do we not? Do we make the loan? Do we increase the loan or do we not? Many cases, company comes in to borrow, we already have a loan, they want to increase the loan. So ultimately, it's really about making a risk decision. So we have all this analysis, we have this marketplace, we have this industry, and then ultimately it's about what is the decision that we need to make. This chart shows that what we can do is to present a logical credit argument. We look at the industry and the business, whether it's Netflix, PepsiCo, Tesla, or Twitter. We look at the business model. What is the actual business model? We look at the business environment. Look at the actual business environment. When we're talking about digital advertising, remember we had said Facebook is in the digital advertising industry. Now let's ignore for a moment the problems Facebook has had. Many people will say the digital advertising industry is a growing industry. It's a growing industry. So Facebook and Google are making lots of money. But why is it that Twitter and Yahoo and AOL, why have they been losing money? Why have those companies been losing money while other digital advertising companies have been making money? So, so we have to sort of understand the environment with which they operate. In this particular class, we used to look at Yahoo and analyze Yahoo. Yahoo now is still around, but it has been acquired. Does anybody know who acquired Yahoo? Verizon, right. So Verizon acquired Yahoo. In the same class, we used to analyze Yahoo and struggle, losses, flat growth, debt on top of debt. And we're saying, what's going to happen to this particular company? And then eventually it was sold to Verizon. The other thing about Yahoo, it was an interesting company to look at, is that Yahoo was losing money, negative cash flow, increasing levels of debt, but they had an extremely valuable asset, on its balance sheet. Does anybody know what that was? Yeah. Pardon me? Yeah. Well, they did have that, but more it was Yahoo's Japan and its investment in Alibaba. So, are you familiar with Alibaba? That's the Chinese version of
Amazon.
Yeah, Amazon, you're right. And so, even though Yahoo was losing money, got debt, have debt on the balance sheet, and they were struggling, and that's why investors were concerned, stock investors, not debt investors and stock investors, because the stock market was concerned about Yahoo as well. But embedded on its balance sheet was this asset, was investment of Alibaba. Alibaba eventually went public, and the value of investment skyrocketed. It skyrocketed. So at one point in time, Yahoo's investment in Alibaba exceeded $20 billion. So some lenders said, as long as they had that asset, I don't care about the cash flows because they can sell parts of that investment to pay down my debt. Some were concerned about the fact that they were making money on the Alibaba, but there are tax liabilities that are actually related to it. So eventually what happened is that the marketplace, what Yahoo did is they split off, and then the unprofitable business is what Verizon bought out, because they were able to buy that out pretty much at a very deep discount, and then the Alibaba part went elsewhere. So that's understanding the risk environment. The business environment. Then there's an understanding of this company's risk. A company has specific risks, and we'll talk about the approach to that. And then we'll do our numbers analysis. look at the history, and of course, we use insight and judgment to see where's the company going. We take that into consideration, come up with a risk rating, and then after we come up with a risk rating, then we say, what's the strategy? Should we increase? Should we maintain? Should we reduce? Should we get out? What should our strategy actually be? And then we make a risk decision. We do the loan, we don't do the loan. We buy the bond, we sell the bond. Ultimately, everything leads to a risk decision. Now, as we said that we're lenders and investors, we understand that we have to take risks to make money. We have to take some risk to make money. If the company has no risk, there is no loan spread. We'll talk about loan spreads. There is no credit spread. If the company doesn't make money, the company is a U.S. government risk rated 1 or 2, there's no spread. And so, to a certain degree, we have to take some risks so we can get some credit spread. But how much is too much risk?